This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll break down a merger between two of the world's largest advertising groups.
Plus, we'll discuss why shares of the computer tech company Oracle fell by the most in a year.
But first, we dive into how a planned U.S. supermarket merger between Kroger and Albertsons crumbled. And this came after Albertsons terminated their pact.
Albertsons also said it filed a lawsuit against Kroger, claiming the company failed to exercise best efforts to secure regulatory approval.
The lawsuit comes after a federal judge blocked the deal, saying the merger would lessen competition and raise prices for U.S. shoppers.
For more, we are joined by Jen Reed, Bloomberg Intelligence Senior Litigation Analyst.
We first asked Jen if it's common for merger partners on a broken deal to sue each other.
It happens once in a while.
Okay.
I'll say it's pretty rare, but it has happened. I mean, think about Anthem and Cigna. I don't know if you remember that deal from back in 2015. Yep. It fell apart also, and there was litigation for a couple years after the deal was terminated in Delaware, and they both came out with nothing. Spent a lot of money and both came out with nothing.
Is it true that you think that Kroger didn't do enough here? Like, do they have a leg to stand on, Albertson?
I think a breach of contract claim based on, failing to abide by sufficiently defending against the antitrust claims is very difficult because, this is really very subjective. And to some extent, when companies go to court and they have a remedy, they're sort of rolling the dice. They're hoping they'll convince the judge, even though they didn't convince the FTC. And I'm not so sure that you can think of that as a breach. In this case, though, having been to trial, the remedy really was deficient. I mean, it was very difficult to understand how a judge, after the FTC presented their case on how this deal could cause harm in thousands of markets, how a judge could accept the remedy that had been put forward by Kroger, which was really very piecemeal, very complicated and difficult, and didn't really have the best buyer. So, we're going to have to see what happens here with this.
But again, I kind of thought that's kind of partially what a breakup fee kind of covers there. I mean, if this deal doesn't go through for whatever reason, you guys wanted to buy us, you initiated the deal. If it doesn't go through, you got to compensate me.
Right. That's exactly right. The seller has a difficult time during that interim period, right? They lose employees. They can't always enter new supply contracts. So this is really intended to make that seller whole. In this case, I think now Kroger's turned around and said, no, it was Albertsons that breached the contract. And of course, they're probably doing that to get a little bit of leverage here. Maybe the hopes would be that they could settle for something less than that $600 million breakup fee in order to make all the litigation go away. Maybe that's what's happening here, just a little bit of leverage. But, again, we'll have to see what happens. It would be a shame if they continue to litigate this and spend millions more dollars.
Good for the lawyers.
Do you think that the deal... Dumb question. Is the deal really done?
Oh, yes.
Like killed for sure?
It's done. So Albertsons is already terminated. They exercised their right under the agreement to terminate. So it is done. The deal agreement is no longer good. So if they even wanted to do another deal, they'd have to enter a new agreement. And now, obviously, there's antagonism between the companies. All
right. In your world of antitrust, what is the expectation of change given a new administration, given, a Republican-controlled House and Senate? Is there any expectation that things will get easier?
I think it will get better. I think some of the exuberance on Wall Street is maybe a little overdone.
Okay.
These huge deals between competitors are still going to get challenged. And we have to remember that the two Republican FTC commissioners who will still be there on the commission both voted yes to sue the Tapestry Capri deal and to sue the Tempur Sealy mattress firm deal. They both said, yes, we should sue. So they are aligned in some respects with suing the deals that could cause harm. I do think what we're going to see, though, is an uptick in deals that can close with settlements. We didn't have any of that in Biden. The Biden enforcers did not want to settle deals. If the deal was bad, they wanted to challenge the deal, and that's what they did. I think in this case, once we have a majority at the FTC and new people at the DOJ, we're going to see that list of settled deals that then go on to close grow.
What do you make of the potential new FTC people coming in?
Well, I'll just
that we
say
know
this.
about?
If Lina Khan's mission was to stop consolidation and revitalize antitrust, their mission is going to be to stop what they perceive as censorship of conservative viewpoints by big tech platforms. There has been a lot of talk about that, even suggesting that there could be collusion amongst big tech platforms to censor conservative viewpoints, and that the FTC should be going after these companies under the antitrust laws to stop that. And I think that's going to be a big focus.
So what's the timing there at the FTC and the DOJ? When do the new sheriffs, if you will, kind of get in town?
The FTC could be, DOJ will be quick. These people will leave. The appointees by Biden will leave in January. Okay. And that is the expectation also, that Lina Khan at the FTC will leave in January. As soon as Trump is inaugurated, January 20, then Andrew Ferguson will become the chair. If Lina Khan's still there, she'll then just become a commissioner. But she will probably leave, and then at that point, he just has to get his new appointment, Mark Meader, through the Senate confirmation process. It could take a few months. You know, he has a majority in the Senate and the House. I don't think it's going to be too difficult. So it'll be a few months, and in the meantime, it'll be a 2-2 FTC probably. The DOJ will change over more quickly, probably in January.
So if I'm a company and I'm interested in buying another company, do I get on the list now? Do I wait until all this stuff is cleared and then I get on the waiting list to get my deal done? Like, what's my strategy?
I think if you know that it has some issues, if you know you're probably going to get investigated, you can go ahead and file it now, because you have 8 months ahead of you, and the new people will be the decision makers. If you have a deal you think has no issues and could get through in 30 days, maybe you wait, right? Because you have a greater hope of just getting it cleared in 30 days once the new people are in.
Our thanks to Jen Reed, Bloomberg Intelligence Senior Litigation Analyst.
This week, we focused on a Bloomberg Big Take story entitled Jane Fraser Stares Down Skeptics Ahead of Citi's Critical Year.
You can find it on Bloomberg.com and the Terminal, and the story looks at extensive reporting and an exclusive interview with Citigroup CEO Jane Fraser, and it illustrates her 5-year plan to turn the bank around.
For more, we were joined by the story's author, Todd Gillespie, a Bloomberg Finance Reporter.
We first asked Todd to break down his reporting and how Citigroup has done recently.
Banks, generally speaking, as a sector, have done really well this year. You know, Citi's kind of sitting middle of the pack of the top 6 major US banks. So they're doing okay. You know, Mark Mason, the CFO, said that the bank is set to hit the top end of its revenue guidance for the end of this year. So after years of disappointing people, you know, investors, analysts slowly maybe starting to think that she can turn this ship around. But it's a huge task.
Why is the ship so big, and why is it so hard to turn?
Well, Citigroup was once, before the financial crisis, the world's largest financial company. It was the US's largest bank. This is a company that is probably the most global bank in the world. It's the only bank, for instance, that has a significant presence in Lebanon, where it had to evacuate staff earlier this year. We reported that earlier this year. And so, you know, it's one of those banks that is so sprawling, which is one of its advantages, because it gets, you know, it enables it to have this incredible global network of payment systems and M&A advice and, you know, experts in all sorts of different countries, but it's also a big hindrance. And one of the things that Jane Fraser has tried to do is exit, you know, 13 of its retail markets where it has retail banking presence. It's about to IPO its retail business in Mexico by 2026. So it's really kind of trying to straighten, downsize in the right ways, she's saying, and also increase its fee businesses like wealth management and banking as well.
What does Citi want to be when it grows up? Does it want to be JP Morgan? Is that the aspiration for Citi, or do they have a different strategy?
I mean, it's hard to compare, but yeah, I mean, I'd probably say JP Morgan is I'd say small steps. You know, I think Bank of America, the way that Bank of America came out of the financial crisis was something that Citi could have only hoped to emulate, right? Citi has really been a laggard since the financial crisis, in a way that Bank of America was able to suddenly turn that ship around fairly strongly. Citi is only just managing to maybe start do that. You know, it has a very large services business, payments system, just like JP Morgan. It's obviously its banking business has been traditionally one of the smaller on the M&A side, but larger on the DCM and ECM side. So it's trying to see if it can kind of even out those businesses as well. So yeah, it's unclear. I mean, yeah, maybe if Jamie Dimon had stayed at Citigroup back in the day, it would have had a very different trajectory.
In talking to shareholders and talking to analysts, what's the vibe on Jane Fraser? Like, is she doing a good job? Is it? I mean, I realize it's only halfway through,
So what's the confidence level?
Yeah, well, she's past halfway through now. I mean, she set out these targets in March 2022. She says that by the end of 2026, she can get to a return on tangible common equity of 11 to 12%. They're sitting rather unhappily just under 7% right now, which is one of the key metrics that investors and analysts are quite unhappy with, to be honest. But people like her as a CEO. You know, people respect her. She's pretty forthright. She's got empathy. You know, regulators. You know, folks. I think people like dealing with her as a person. But obviously, when you take a bank through this massive change, you know, right? They announced 20,000 job cuts at the beginning of this year. 9,000 of those still to go in the next 2 years. It's you know, you're obviously going to have enemies and people who really don't like the way that you're moving this thing around.
What's next for Citi in their turnaround plan? Is there a milepost that investors are saying, boy, this is the next thing we need to see?
The next thing everyone needs to see is positive operating leverage that really consistently comes through. That's revenues outpacing, growth in revenues outpacing expenses for them in the next 12 months. And they also really want to see strong growth towards that ROTC, that returns target, every quarter by quarter. And that's a kind of consistency that Citi has lacked for the past decade. Yep. That Jane Fraser is really trying to bring back to the business and show investors that they can believe the targets that she and her CFO Mark Mason set out and actually stick to those, so that they have that confidence in the market, that they can get rid of those regulatory burdens that have kneecapped them for so long, and that Citi can really come out of this stronger, more streamlined, and finally, you know, put behind it this bloat that has really weighed it down.
You also mentioned in the piece about how they do good numbers, they deliver good numbers, they don't get the credit for it in earnings. What's up with that?
Totally. I mean, every quarter, they're, you know, if they post strong revenues, it's the ROTC number that's not quite right. If the ROTC number is good, it's revenues that aren't quite right, or it's something like that. And you know, these are often battles really on earnings calls. These are longer earnings calls than most banks have, and you can really listen to those yourself. They do get quite colourful and quite lengthy, so you know you need to have an extra shot of espresso while they're going through.
Our thanks to Todd Gillespie, Bloomberg Finance Reporter.
Coming up, we'll break down the carbon market and why it's a key part to transforming the energy landscape.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to a big deal in the media space. This week, we heard that Omnicom Group is acquiring Interpublic Group to create the world's largest advertising company.
The deal values Interpublic at $13.3 billion, and the merger is seen as a response to the changing advertising landscape.
For more, we are joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We first asked Geetha exactly why this deal happened.
Over the past 10 to 15 years, advertising has been completely disrupted by the likes of, Google and Meta, where we've seen a complete shift of ad budgets from traditional mediums like, TV and radio and newspaper to really all digital forms of advertising to the internet. And so there has been a lot of disintermediation with the ad agency holding companies, all of these, Madison Avenue type of agency companies. There are only really a handful of them left. So you have the big four. Omnicom and Interpublic are, of course, two US-based agencies, but the bigger ones are their European rivals, Publicis and WPP. And really what they're trying to do here is, it's become such a data-driven business. There is so much competition from big tech. And now, of course, with the advent of AI, this threat of disintermediation is only growing more and more. And I think this is absolutely the right time for consolidation. And this really just tells us about the amount of secular pressures in this industry, very, very similar to the linear TV model in a way.
How cost intensive is this business? How much do they spend on labor, for instance?
60%. 60% of all of their costs are on labor. So really this merger in so many ways, John, is really about saving costs. They already outlined about $750 million in cost synergies. And of course, that is likely to go up as they kind of eliminate redundancies. And if you just kind of look at it over the course of the next 10 years, I mean, there have been multiple studies that have been conducted that have said that, with AI, being able to create campaigns, being able to create all of these, the creative elements of what an ad agency does, almost 33,000 jobs, or close to almost 40% of the ad agency sector's jobs would have anyway been eliminated. So it is really going to come down to saving on labor.
Wow. So in this world where it's Facebook and it's YouTube, and if I'm Coca-Cola and I'm Ford Motor Company and I'm going to do a big advertising buy on one of these digital platforms, how different is it than 40 years ago when I was just advertising on network television?
Yeah, it's really different now because all of these small businesses actually now just go directly to Google and Meta.
Yeah.
So the way that it is now working is all of the small mom and pop stores, medium-sized businesses are not going to these ad agency networks anymore. So it's really only a handful of these big brands that are really still, having their campaigns kind of designed by the big, ad agency networks. And even in those big brands, even brands like P&G, even brands like Apple are really kind of going more and more in-house. So it has become really difficult for the ad agency companies to kind of survive in this changing world. And they have to keep adapting, and they have to keep acquiring more data-centric businesses. They have to keep investing more in AI, really, and in data. And if you kind of just look at Omnicom and Interpublic versus their European rivals, they're actually lagging behind a little bit in terms of AI and tech investments. And I think this deal was kind of prompted a little bit by that as well.
Can AI really deliver a creative execution for these firms?
Yes, it can. Maybe not at the highest level, but I think as the algorithms kind of keep getting refined, we are definitely going to see a huge level of disintermediation. And even today, we talk about, these companies talk about how AI is helping them kind of refine their campaigns, kind of refine the messaging, get to better targeting. So AI is definitely a very, very useful tool. And if you just kind of look at even Omnicom and Interpublic over the past year, one of the reasons why Interpublic has kind of been so keen for the sale is because it has been losing so many clients. They lost a very, very important client with Amazon, and really a whole string of account losses kind of precipitated this whole sale process. And on the other hand, if you look at Omnicom, they've actually have an AI assist tool called Omni, which has helped them kind of really win a lot of clients. So we've kind of seen the two agency groups have very differing performances.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we took a look at the carbon market, a key part to transforming the energy landscape. For more, we were joined by Bo Chin, BNEF, Head of America's Environmental Markets and Weather Analyst.
We first asked Bo to discuss what she's currently seeing in the U.S. carbon market and what she expects in the year ahead.
The U.S. carbon market is now going through ups and downs. So this year has been super exciting year for U.S. carbon markets. We have hit record highs. The most interesting carbon markets in U.S. are on the coast. So we have on the west coast, California, linked with Quebec. And then on the east coast, we have Regional Greenhouse Gas Initiative, which is the power sector-specific carbon market focused on 10 states. Both of these markets have seen price records. So looking at just West Coast, the California carbon price went up 40% since 2023, hitting a record $44 per ton. And we have seen these prices actually, unfortunately, this year come down 30% this year. And this is because of the reforms that have been proposed and also the delays of these reforms. On the East Coast, we have a similar story. So it was a very bullish story up till September, with prices moving up 70% to $28 per short ton. And then prices have since also come down 25% because of the reforms. But we do expect next year to be a very exciting year as these reforms get concluded and we see more policy certainty within these markets.
explain it to me like I'm a 5-year-old. What drives the price of carbon?
I was going to ask that too, actually.
Okay.
Yeah, carbon markets really is like
Is it a commodity?
Yeah, definitely.
Okay, it's commodity, so supply and demand.
Yeah, it's
so
supply demand. It's basically, you can think it as a farmer's market where polluters go to buy permits and then abaters go to sell their permits. It depends how big family you're feeding, how much demand is for that abatement, then that drives the price. In our world, we call that demand and the price is a marginal abatement cost curve. So if you have a strong demand or a strong climate ambition and a very limited marginal abatement cost curve, that would lead to a high carbon price. And then vice versa, if you have low demand or low climate action and a very significant marginal abatement cost curve, meaning that you have cheap abatement and a vast amount of it, then you would have typically a lower carbon price.
So to me also, the idea with the carbon price is if you get it high enough, then companies are going to want to like store their carbon because they're going to be able to then trade that credit and get money for it, right? So the higher it is, the better it is for the environment because companies will be more incentivized to store their carbon or not produce it or to sell it, right?
Yeah.
But what is that price?
It really depends on the supply and demand as it's a commodity.
But like, are we talking about like $80 would really be a good incentive? Is it $100? I mean, any commodity is going to have that incentive price.
Yeah, exactly. It depends on what technology you're looking at. What is the trigger point? Trigger price. So if you look, we typically say that the cheapest is the coal to gas fuel switching, and that also depends on the market. So in Europe, that typically is higher than US, where gas is already very low. We also looked into this that not only power sector now is the ones that are being triggered, but also transport, where you tilt from ICE vehicle to an EV, and a carbon price can help you to do that. And also carbon price doesn't work alone, so there's a lot of complementary policies. We're pretty much the final defense. So if other complementary policies didn't deliver the results we wanted to see, then carbon price can do the final lift, hopefully.
Interesting. So real quickly, change in administrations coming up. What does that mean for your world?
Yeah, it's really exciting actually for us. Maybe for the clean energy sector, it's maybe not such positive news as potentially some subsidies like Inflation Reduction Act and other complementary policies for renewables and clean transport will be now reduced, and there'll be more support for oil and gas industry. But for carbon market, this could be a good thing because we would have more emissions that would support carbon prices, but also a lot of states could now really double down on carbon market as a policy tool to support prices. Also for investors, carbon price could become an attractive tool to invest because naturally carbon markets, particularly those compliance carbon markets, can hedge inflation, which could become a topic now with the immigration rules and tariffs being changed with the new administration.
Quickly, is it a bad thing that it's so fragmented?
Yes.
Do we ever get to a place where there's like a U.S. carbon price?
We do hope so. For U.S. National level carbon price, it will most likely not become a realistic thing in the next few years, but we could see more states linking. Like even right now, we are seeing that Washington, which survived the repeal ballot actually in November as well, so now there's more opportunity for Washington state to be linked with California. There are also other states that are talking about having a compliance carbon market, actually right here in New York. Okay. Very excited about Nikki. I'm excited to make the son of Mickey to become a hey Nikki. So New York is going to be economy-wide, and it's going to be similar size to California. Okay. So if these all get linked, then we could have a maybe not an official national, but a benchmark price.
Our thanks to Bo Chin, BNEF Head of America's Environmental Markets and Weather Analyst.
Coming up on the program, we'll discuss why the department store chain Macy's trimmed its profit outlook for the year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the computer tech company Oracle. This week, shares of Oracle fell by the most in a year.
That's after the company reported second quarter profit and revenue that missed analysts' expectations.
For more, we are joined by Anurag Rana, Bloomberg Intelligence Technology Analyst.
We first asked Anurag what Oracle's results say about its business.
See, when you look at the constant currency growth for Oracle Cloud Infrastructure, it was 52%. And I think consensus was 51. So a slight beat, but the reaction tells me it was not good enough for buy-side investors. From our side, there's no problem in terms of future growth prospects for that business because backlog's very strong, the demand is there, and for Oracle, they're actually getting work from Microsoft because Microsoft is leasing their data centers because it is having a huge backlog of work on their end.
So does that mean this is just hey, the stock could run up really fast, therefore it was just the expectation game? Is that what I can read into the equity market?
I would absolutely say that because right now this has been the trade for 2024 has been the infrastructure that's related to AI. So whether that's the chips, even the numbers were pretty good. And 2025 could be a year where you will see the downstream impact of some of these AI infrastructures, which is cloud companies or other software companies coming up with applications that are based on some of these AI infrastructure. So we have a long way to go before we realize the true value of AI spending across the entire value chain. For this year, we just saw it in the cloud and the chips part of it.
The demand is so robust, Anurag, that I've heard companies talk about maybe even some shortages of some components of some of the things they want to buy. Talk to us about that. What did Oracle say?
Yeah, Oracle is no different than other companies because even for Microsoft, they cannot get up data centers at the same rate as they're seeing demand coming from OpenAI. They are not. Everybody's having struggled to procure NVIDIA GPUs to train some of these models, and that's the case. Oracle's backlog is so strong, but there has been supply challenges. They are spending a lot of money on capital expenditure. Last year, approximately, they spent about $7 billion in capex. This year, it's going to be double of that, almost $14 billion. So, I mean, we see that when these companies spend money to expand their capacity, we know that demand is behind it.
So this is like the software stuff. So NVIDIA supplies the chips for Oracle, who then builds the software stuff for companies like Accenture or Amazon. Is that correct?
Yeah, it's you got it right. In this case, what's happening is companies like Microsoft, Google, AWS, and Oracle are building an infrastructure on which companies can build applications. So these companies could be Accenture, it could be JP Morgan, it could be Citibank, etc. These companies will go out and create their own AI apps that can then be used internally by the companies. And I mean, you can do this in-house also by buying AI servers, but cloud is usually a better and a cheaper way to go because you can turn it off if you don't like it. So that's what we are seeing right now.
Is peak AI anywhere on the horizon there, Anurag?
Are you allowed to say that?
That's a very, very good and tough question, frankly, because the question is going to be, will people get bored in the AI infrastructure space and will they move to somewhere else? We saw that in the last 3 months. Suddenly the interest in Salesforce, for example, and that is because Salesforce is the second leg of this equation. One is the infrastructure we talked about. Second is the application. Salesforce created some AI application that can help you do, fix your online orders automatically, do some refunds, etc. So that's the application part of it. We think next year there's going to be a lot of Salesforce-like applications that will come to the market by different software companies that will help people be more productive. And then the third and the final layer would be the consulting companies that are helping in the implementation of that. That goes in tandem with software companies, but we think there are multiple years before we see the true realization of the funding that's happening right now.
All right, quickly, Anurag, Adobe is a competitor to Oracle, and what did we learn from Oracle as it relates to Adobe?
Yeah, they're both software companies, but they do slightly different things. For Adobe, the big question is going to be, is their business being cannibalized by open source AI tools? We don't think that's the case right now, but that's a big argument in the space. If you look at the entire software space right now, Adobe is probably the one where you have the biggest argument whether they're going to be the net beneficiaries of AI or whether they're going to get hurt by AI. For Adobe, we expect them to come out and say that the adoption rate of their own AI tools is picking up, and that's really what we are looking for.
Our thanks to Anurag Rana, Bloomberg Intelligence Senior Technology Analyst.
We move next to the retail space and Macy's. This week, the department store chain said it had trimmed its profit outlook for the year.
This comes after Macy's concluded its investigation into an employee that hid millions of dollars in expenses. The discovery of the accounting errors led Macy's to delay its full earnings report back in November.
For more, we were joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst. We first asked Mary to walk us through Macy's recent investigation.
What happened here is that they had a single employee who basically hid small package delivery expenses of about $151 million. That was over a 3-year period. So for the year to date, I think it was about $9 million is the effect in the, for that period. So the company, of course, had to lower their guidance and the gross margin figures and EPS, of course, because it drops all the way down there. But it doesn't affect cash. So that's the good news. And it's put behind them. What they have done is they've improved their financial controls. They've added some additional checks and balances there. So I think this is now behind them. And I think the real focus here is on the go forward operations. And I say go forward, meaning let's exclude the 150 stores that they're going to close. 65 of those stores will close in the fourth quarter. That's ahead of the original 50 they slated to close. And then the other 85, maybe that'll get done by next year instead of the next 2 years. Nonetheless, if you put those aside and you look at what's going on with the go forward business, we're seeing sequential improvement with the first 50 stores that they've completely revamped actually posting a positive increase. They were up 1.9% in the third quarter, and that's the third quarter of positive comp improvement there. So we're actually seeing signs that the plans, the initiatives that they're employing are working. So we see some green shoots in there. And we think this accounting issue is behind them.
All right. What does a revamped store look like? What's the strategy behind a revamped store?
Paul, that's a good question. So what that means is they've really upped their game in terms of merchandising. They've brought in new brands like La Avec Fille, Donna Karan, Karl Lagerfeld, Steve Madden. These brands offer great style and value to the company. Their private label program has been completely revamped. Now that's only about 15% of sales, so the biggest part is really bringing in these other brands. But not only that, they've upped their game in terms of service. They now have salespeople in the shoe department, and then they have runners. So what happens is a salesperson will be working directly with a client, and they'll say, hey, I need size 8, size 8.5 in this, and then they run and go get them. And then also they have service in handbags and in women's ready-to-wear. So having boosted the service levels, also improving the overall appearance throughout the stores, we've been in our channel checks watching this happen, and we see the improvement. We see how that they got rid of some brands that were less relevant, brought in these newer ones. And we also saw during that Black Friday, we saw this year more traffic in the stores than we saw in the prior 2 years. And of course, when you look at the data, their sales were better this year. They saw an increase in the Black Friday through Cyber Monday in the consumer transaction data. And that's something the company mentioned on the call today, that yes, they're seeing strong, or sort of sequential improvement versus the third quarter into the fourth quarter. So I think those are some of the
way you're describing, Mary, the revamped stores, it sounds a little bit like Bloomingdale's Light.
You know what? That's exactly, if you look at let's say one of their better, what they would call one of their flagships. So we have one here right next door in Century City. It does very much look like a Bloomingdale's. The store it's brand new. I mean, they've remodeled it 4 or 5 times within the last few years. What I mean by that is they've expanded beauty. So you walk in, it's an incredible showcase of beauty. Also includes Blue Mercury, of course. So we've seen and the stores are so much brighter, but even in a tired old mall down in Southern California that I will go to, even that store looks much better, even though it's sort of a tired location. They've really improved it. The better brands that they've incorporated, making these little Calvin Klein, they look like little boutique shops. Michael Kors, Calvin Klein, Tommy Hilfiger, those are all in there and beautifully appointed. It's much more open. There's not just a sea of merchandise. It just makes more sense. So that's been extended across another 100 stores. So not just the 50, but another 100.
All right. So what's the company saying just about holiday sales so far? Is it kind of confirming what you've seen?
Yes, they did. They said that they saw a good start to the holiday season, but of course we still have more to go. So and they actually raised their guidance a tad. So I thought that was also an indication of what they're seeing, and so they could potentially beat the guidance, because when they put the guidance out, they really attempt to exceed those figures.
All right, thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.